Welcome to Deep Dive with MNCL, where we don't just discuss companies, we dissect them.
Hi guys, this is Nikhil Kanodia, research analyst at Monarch Networth Capital Limited. Whenever we say about packaging, we can think of two alternatives. One being the rigid packaging, that is your paper-based packaging used for cosmetic products, or the flexible packaging, which is your plastic-based packaging like lami tubes and plastic tubes. Today I would like to talk about EPL, who is the market leader, having presence in the entire globe and strong customer relationships. EPL is a major player in the global flexible packaging industry and is operating out of 21 advanced manufacturing facilities across 11 countries, both developed and developing economies, and which are spread across 5 continents. The international footprint is strategically divided into 4 regional setups. The first one being the AMESA, which is Africa, Middle East and South Asia, including India and Egypt, which accounts for around 35% of the FY24 revenue. East Asia Pacific, including China and Philippines, around 20 to 25% of the revenues. Americas, including USA, Mexico, Brazil and Colombia, again 20 to 25% of FY24 revenues. And Europe, including UK, Poland, Russia, Germany, which is around 20% of the revenue. EPL produces laminates centrally in India and China, exporting them to the other regions for conversion into tubes. This strategy ensures freight efficiency and shorter lead time. The company benefits from an established global client base and an average relationship of 20 plus years. The clientele includes players like Colgate, HUL, P&G, Dabur, Patanjali, etc. All these have culminated into a 20% market share of the global TAM of around 42 billion tubes. EPL's clients are committed to deliver on the sustainability front. In order to help them, EPL has been building its recyclable capacity. Currently, 85% of its capacity is geared towards manufacturing sustainable products. Further, to encourage more conversion towards sustainable products, it offers the laminated tubes at no additional cost. Our deep dive analysis of the underlying industries suggests that tube as a packaging format is being increasingly preferred across various industries due to its ease of dispensing, convenience and ability to reduce the overall resource use. Tubes are also effective for branding, making it a perfect choice for the marketers. We see many shampoos and conditioners now switching from the plastic-based bottles to lami tubes. Also, soframycin, which used to come in the aluminum tube, is now coming into the laminate tubes. EPL is incurring approximately 1% of its standalone revenue towards R&D through constant innovation in decoration, structure and chemical resistance to meet evolving demands of the brands. EPL is accelerating shift to new generation lami tubes, which are superior to plastic tubes and the aluminum tubes, and on the terms of sustainability and the total cost of ownership to customers, while maintaining the same barrier property. The company has recently commenced commercial operations in the Brazil plant, which can potentially lead to an inflection in overall revenue and EBITDA contribution from the Americas region. Further, with the completion of the European restructuring program, it is expecting to save around 3 to 4% in cost annually from this region. Further, the gross margins are protected given the pass-through mechanism in place, which helps the company to pass on the change in the prices to the customers effectively. EPL manufactures its own laminate sheets and hence makes better margins as compared to the competitors. We expect EPL to report strong revenue and profitability growth, riding on the back of pharma and the FMCG tailwinds, coupled with robust margin expansion on the back of cost optimization measures and the margin accretive business from the Brazil and operating leverage. As a result, we expect the revenue, EBITDA and adjusted PAT to grow at a CAGR of 10.7, 15.1 and 24.1% respectively over FY24 to 27 expectations. We value the stock at 22 times its September 26 earnings estimate, which is in line with its 10-year average forward PE multiple, to arrive at a target price of 320.
If you thought this was insightful, you wouldn't want to miss our detailed report, where research is king, always.